Hello, everyone, and welcome to our in-depth discussion of the balance sheet. So after reviewing the last video, you now have an awareness and greater appreciation of what goes into the basics of balance sheet construction. Remember, balance sheet shows assets held at a given point in time, along with the levels of liability and equity financing used to fund those assets. Any asset on the balance sheet must be financed with either liabilities or equity. Every additional dollar of liability financing reduces the value of the shareholder's claim on the value of the assets. And so now, with that construct in mind, we want to dig a little deeper into the specifics of the balance sheet. In particular, we want to know what type of accounts show up under assets and liabilities and shareholder equity. And before we dive into a sample balance sheet on the next slide, I want to set up for you in a very basic way, just sort of the nomenclature, if you will, for a balance sheet. Under assets, you have two major categories: current assets and non-current assets. Current assets are those assets that are expected to be convertible into cash within a year or less. So here you're going to see things like accounts receivable, right? Accounts receivable are credit sales we've made to a customer that have already been earned, but we haven't converted them into cash yet. We haven't collected on those sales. Inventory, right? Cash, of course, and short-term investments, those are current assets. Companies in certain industries, though, a lot of their asset holdings aren't in current assets. They're in non-current assets. These are assets that are not convertible into cash within a year. Things like property, plant, and equipment. Property meaning buildings, undeveloped land, any building or office space we may own and use to facilitate sales or to have our headquarters, to have our managerial staff located in. Equipment, any kind of machinery we may need, production equipment, that kind of thing. All right, these are often assets that we will never liquidate or don't plan on it. We need these assets to generate sales, earnings, and cash flows. On the liability side, the nomenclature is similar. We break the liabilities into current and non-current liabilities. Current liabilities are liabilities that are payable within a year. Things like accounts payable, which represent purchases we've made from a supplier or a vendor on delayed payment terms. So it's like the other side of trade credit used to generate our receivables. Payables is when we buy from someone else and they give us a period of time to pay them back. Notes payable, which are debt instruments issued by a bank or other creditor that has an interest rate attached to it. These are those types of notes that are due within the next year. So we could have like a long-term loan, all right, that shows up primarily under non-current liabilities, but the next year's worth of payments on it will show up as a current liability under notes payable. Lastly, we have shareholders' equity, and we'll keep it pretty straightforward here, but we'll note that shareholders' equity has no time dimension to it. There's no current versus non-current shareholders' equity, because the money that shareholders give to the firm when they buy shares in the company, it never matures, unlike liabilities. It never matures. And to get your money back, you simply have to sell shares to someone else. So here's a sample balance sheet. And this is not in the book, but clearly we needed a more realistic looking balance sheet to help facilitate what we're going to do later in the term, and also to give you a better idea of what you'll see in future coursework. Here you've got a balance sheet broken down very simply into assets, liabilities, and equity, and then assets are broken into current and non-current. Same thing with liabilities. So looking at the top, all balance sheets, are classified, meaning the most liquid assets show up first, meaning your current assets show up first. So this company has cash and equivalents of $832.48. And that's in the current fiscal year, we'll assume, at year end. And so cash indicates all funds held by the company and its various checking accounts. Equivalents refers to marketable securities that the company has invested some of their cash into. And so we're earning a decent yield on that. Nothing spectacular, of course, but here we can always liquidate those money market securities very quickly and turn that into cash that we can then deposit into our checking account. So the company has ready liquidity of $832.48. It also has accounts receivable $350. Now those represent sales we've made to a customer already, and we've given them a time period to pay us back. So they owe us $350. Most companies only offer terms of credit terms of say 30 to 60 days. So we should be able to collect those accounts receivable very easily within a year. Inventory, less liquid than accounts receivable. $400 worth of inventory. We hope we can sell off these goods in the next year. If we do, we would add that to cash. All right. Prepaid expenses. This one's a little confusing. We won't spend a whole lot of time in it. And I don't think you'll use it much in your MBA curriculum at all, but it is important to note that prepaid expenses is technically a current asset. And so I know it's confusing because you see the wording expense here. How can that be an asset? Well, think about a company that leases its office space, okay? And maybe you paid for the full year's lease up front. And maybe this balance sheet is just for, say, a quarter, okay? And so if your full lease for the building for the full year would have been for $100,000. Well, the value per quarter is $25,000, right? Just $100,000 divided by 4. Okay, so at the end of the first quarter, you have actually used up $25,000 worth of that prepaid $100,000 lease expense, right? Well, if this balance sheet is for the first quarter, then technically, if you were able to liquidate your position in that lease, then your realtor, the owner of the real estate would owe you $75,000. All right. So it's called prepaid expense, and that you could get some liquidity out of that expense you've already prepaid if you had to. But generally, though, it will show up on the balance sheet here under assets, but we primarily use it as a way to balance the balance sheet. We don't draw a whole lot of insights from it. Your major strategic accounts under current assets are cash equivalents, receivables, and inventory. Under non-current assets, we have net property, plant, equipment. PP&E is property, plant, equipment. And that's a sum total of $3,900 on an actual exhaustive type balance sheet for a corporation that you may pull for one of your class projects. You'll find that net property, plant, equipment will have multiple lines of it for a real company, say an Apple, a Caterpillar, a Walmart, a Costco, right? They're going to show you line by line the different types of property, plant, equipment that they hold. Here we're just aggregating to keep us simple. Okay, so as you can see here, most of this company's assets are held in net property, plant, equipment. Those are typically longer term, less liquid assets. Our total asset base is $5,537.48. So the value of our holdings right now at this point in time is that much. Then we turn to how are these assets being financed? And that's where we get to the liabilities and shareholder equity section. So the liabilities section is broken up into current liabilities and non-current liabilities. So your current liabilities consist of accounts payable. Those are amounts that we owe to suppliers or vendors. We received a service or a good from them, and now we have to pay them back. Accruals represent amounts owed for various things, such as wages payable to employees, maybe taxes payable, that kind of thing. Notes payable represent amounts due on like lines of credit. If we borrow money on a line of credit, if we have a credit card balance, if we have payments due on a long-term loan, the payments that are due in the next year would fall under notes payable. That's $290 for this company. Current maturities of long-term debt. If we issued a long-term bond, okay, the amount that's due in terms of principal and interest during this year would show up right here as $50. The total sum current liabilities is $575. Okay, so if shareholders and creditors alike are going to watch that current liability figure very closely, because they're going to want to say, okay, this is the amount that the company owes in the next 12 months. Does the company have sufficient financial resources to cover those? So they're going to look up the current assets and say, okay, Are current assets above that or not? Current assets are above that. Okay, so suppose the company has some kind of hiccup and doesn't generate any additional revenues or cash flows in the next year. Theoretically, it could cover all of its current liabilities just with its cash. Right, that's one basic examination on this. Not that the company would want to do that, but just in case. Right? Long-term debt is very high here at $950. That's very common for a lot of companies. They will use long-term debt to finance the vast majority of their assets. And that's not dissimilar from what we as individuals do. I would imagine most of us that own homes probably prefer a 30-year fixed rate mortgage, right? And you like the longer term, it gives you more time to pay it back. It locks in your rate. Long-term debt offers companies the same ability. You know, you have a longer time to amortize the debt and you lock in your rate versus the interest rate on like a line of credit. So total liabilities are $1,525. So one of the first things you want to do when you look at a balance sheet is compare assets to liabilities. You see that gap, right, between assets and liabilities? That implies that this company is, in fact, solvent. It's solvent. We have positive shareholder equity. And shareholder equity is $4,012.48, as you see more towards the bottom. Also shown in this balance sheet is the two components of shareholder equity, the two primary types, two components of shareholder equity that you'll deal with throughout your term, throughout your MBA program. That's common stock and paid-in capital. PIC stands for paid-in capital. That represents the amount of funds that the company raised when it went public. All right, so again, the balance sheet only shows the book value of assets, liabilities, and equities, not the market value. So when the company went public, it raised $750 worth of financing. Now, just because maybe the company's stock price increased doesn't mean that value changes. It doesn't. The company receives no tangible benefit on the balance sheet from its stock price increasing. Now, I was very careful in my wording there. It will see a long-term benefit from the stock price increasing in that they can more easily issue securities in the future, and they will issue fewer shares to raise the same amount if their price is high, right? Lastly, retained earnings is the final component of shareholders' equity, and that's $3,262.48. That is a very important component of equity because that shows us the internal equity we've saved over time. Retained earnings, the name really says it all here. We've had earnings or net income that we have retained. That comes from revenues that we've earned that we haven't lost out to expenses, and that we haven't paid out to dividend holders, to shareholders, okay? So year over year, as we're more successful and we earn positive net income, that gives us a higher and stronger ability to retain earnings. So bottom line, notice that shareholders' equity and sum of shareholders' equity and total liabilities sum to be equal to $5,537.48, which means the balance sheet balances. So no shock there. So some key insights from the balance sheet. Number one, it shows the degree of debt used to finance assets. We'll have some more comment on that coming up when we look at a common size balance sheet. But for now, let's just think of the mix of debt and equity financing as being known as capital structure. Capital structure refers to the intentional decisions made by management in terms of deciding how much in liability or debt financing will we use versus equity. And one key thing to note here is that a capital structure with increased shareholder equity in it indicates positive financial health and a lower level of firm risk, which means lower interest rates, higher credit ratings, lower cost of capital. It's very, very important. The reverse is also true. A capital structure with lower shareholder equity, which implies higher liabilities, indicates negative financial health or a weakening financial condition and higher risk. Just for your information, use of debt financing is commonly referred to as financial leverage. Having more financial leverage in your capital structure is seen as a potentially a dangerous thing. It's definitely a higher risk, higher return proposition. You'll see a lot more on this topic in your corporate financial management course. Another key insight from the balance sheet is that it shows the mix of current assets and current liabilities, which then indicates the degree of firm liquidity that the company currently has. So let's define this very carefully. Firm liquidity, for our purposes in this course, will refer to the degree to which the firm can meet its bills when they are due. So can I easily meet my financial obligations when they're due? Okay, very important. If I'm systematically late, ultimately my creditors, which can include my financial institution relationships or my relationships with my suppliers or vendors, can become damaged, and I don't want that. The last thing I want to do is damage a supplier relationship. They're the ones giving me these inputs that I need for my production process, right? Firms with more cash are deemed more liquid. So when we look at that cash and equivalents line item on the balance sheet, you really always, and it's easy to note that one because it's first, right? You always want to take it and then go straight down to current liabilities and say, is this greater than that? If it is, then you're clearly in some kind of good shape, right? Management of current assets and current liabilities is known as working capital management. So current assets and current liabilities are known as working capital. That capital that's very short-term in nature, that's what you can work with on a day-to-day basis. Longer-term capital, such as raising equity financing, retaining earnings, issuing long-term debt, that you don't get to work with that quite as much, and that it takes more time to raise it. A general operating principle of working capital management is to match your level of current assets to your current liabilities. If you think about a balance sheet, right, assets equal liabilities plus equity, you want to think of magic, okay? And with current assets, as long as current assets are roughly equal to current liabilities, then you have a good match there. So if interest rates increase or decrease, both assets and liabilities are impacted in the same way. If current assets exceed current liabilities, that's okay too from a liquidity perspective, but it also means your assets are going to be impacted more severely by changes in interest rates. All right, last thing in this video on balance sheets. One of the issues with balance sheets is that if we're looking at our company over time as we grow, we can run into an issue there, because if we're trying to track our trends and see more about our company, draw some insights on whether we're becoming more or less healthy from a financial perspective, it's hard to determine that as the company's size changes. It's hard to compare the company to another company if the size of the companies are different. That's where common sizing comes in. Common sizing involves scaling everything on a financial statement by the same variable in that year so that you get a common basis. And for the balance sheet, the scalar for common sizing is assets. It's assets. You want to take total assets and divide everything on the balance sheet by total assets in that year. And so that's why we have a new column here on this sample balance sheet. And it's called percentage of total assets. And so all I've done is divided every item in that current year column by total assets of $5,537.48. That's why you see 100% value for total assets. Okay, so let's start with the asset side of the balance sheet. Those percentages tell us a very important story. Let's look at the gray shaded bars first. We see that of this company's balance sheet, of its assets, 30% are held in current assets, 70% are in non-current or long-term assets. The composition of the balance sheet is very important. Okay. In particular, cash and equivalents are 15% of assets. So the vast majority of our current assets are cash equivalents. That's in general a good thing. Okay. And then you see the other percentages. Move on down the balance sheet. And this is where we get into being able to draw some insights or commentary with respect to our capital structure. Focus on the gray bars first. Total current liabilities are 10% of current assets. Total liabilities are 28%. Notice 10% and 17%, a little bit of rounding there. That's fine. Okay. 28% of our assets are financed with liabilities. Is that good? Is that bad? Right now, you may not have the knowledge to make a comparison on that. In general, what you're going to find in future courses is that companies with a balanced capital structure, meaning 50% liabilities, 50% is equity, is generally an okay thing for most companies in most industries. But once we start to have liabilities being more than 50% of assets, that's where we can run into trouble. And the trouble comes from the fact that the credit market will say, hey, wait a minute, you're getting over leveraged. We are worried that you will have the ability to meet these financial obligations when they're due, these principal and interest payments. Therefore, we'll still give you capital, but it will cost you a higher rate. And at some point, you'll become so over leveraged that financial markets won't even provide you any more capital because they're so worried about you. Moving on down, equity is 72% of total assets, meaning that 72% of assets are financed with equity. For every additional dollar of assets we have, we finance 72% of it with equity. That's a strong statement. That's indicating that this company is not overusing financial leverage. They're not overusing their liability financing. Notice that 72% plus 28% gives us 100% for total liabilities and equity. So common sizing the balance sheet has a lot of benefits here. It just makes these large numbers a little more manageable to interpret. Also, we can compare our company's balance sheet financing across time as we grow or shrink. And we can also compare ourselves to our peers. Even if we're a small privately held company, maybe we only generate $50 million a year in revenues. If we know what our industry, our publicly traded industry peer group looks like on a common size basis, then we can compare our percentages. We can't compare our raw numbers necessarily, but we can compare our percentages to see where we stack up in terms of the mix of our assets versus our liability and equity financing and the composition of our assets.